Starting a new business is like standing at the edge of a vast ocean, staring into the depths of possibilities and uncertainties. You've got your idea, your passion, and maybe even a few sketches of what your dream could look like. But then comes the reality check. How do you fund this venture? Capital is the lifeblood of any startup, essential for covering those pesky startup costs, supporting your growth, and keeping the lights on until you start seeing that sweet, steady revenue flow. So, let's dive into the world of funding options, shall we? First up, we have bootstrapping. This is the classic self-funding route where you dip into your own savings or use the early revenues from your business. It's like putting your money where your mouth is, literally. The beauty of bootstrapping is that you retain full control and ownership of your business. No debt, no interest payments, just you and your vision. But let's be real for a second. This option is limited by your personal financial capacity. If things go south, you're staring down the barrel of high personal financial risk. It's a great fit for small startups with low initial costs, or for those founders who just can't bear the thought of giving away a piece of their pie. Next, we have friends and family funding. The classic, "Can I borrow some money?" conversation. This approach involves raising funds from your close network, usually in exchange for a small stake in the company or a personal loan. It's flexible, often easy to access, and can come with favorable terms. But tread carefully here. Mixing money with personal relationships can lead to some awkward family dinners if your business struggles. It's advisable to formalize these agreements to protect both parties. This route is best for early-stage startups needing just a little boost and founders who have a solid support network. Then we have angel investors. Think of them as the fairy godmothers of the startup world, high net worth individuals who provide capital in exchange for equity or convertible debt. They're typically looking for high returns, but they often come with mentorship, industry expertise, and networking opportunities. It's a win-win, right? Well, not so fast. You'll need to give up some equity, which means less ownership for you. Plus, angels might want a say in how you run your business. This option is ideal for startups with high growth potential that are looking for both capital and strategic guidance. Now, let's talk about venture capital, or VC. This is where the big bucks come in. Professional investment firms are ready to provide substantial capital investments in exchange for equity, but they expect significant returns. VCs don't just throw money at you. They actively participate in business decisions and often appoint board members. The upside: access to resources, mentorship, and a network that can help scale your operations. The downside: you'll likely give up a considerable chunk of ownership and face pressure for rapid growth. This is best for startups with scalable business models, especially in tech or high-impact industries. Have you heard of crowdfunding? It's like a modern-day treasure hunt where you raise small amounts of capital from a large crowd, usually through online platforms. There are different types of crowdfunding: reward-based, equity, and debt crowdfunding. Reward-based crowdfunding is where backers receive non-monetary rewards, like early access to products. Equity crowdfunding allows investors to own a piece of your business, while debt crowdfunding involves backers lending you money that you'll repay with interest. The benefits: crowdfunding can build early brand awareness and customer loyalty, and you don't have to give away significant ownership in reward-based models. But it requires strong marketing and preparation, and success hinges on meeting your funding goals. This is perfect for innovative products with broad appeal. Let's not forget about small business loans and lines of credit. These are traditional routes where you borrow funds from banks or online lenders and repay them over time with interest. Loans give you a lump sum, while lines of credit offer flexibility. The great thing is that you retain full ownership and control. However, lenders usually require good credit and collateral, and you'll need to repay the debt regardless of how your business performs. This option works well for established startups with a revenue history. Government grants and subsidies are like the unicorns of funding. They're non-repayable funds provided by government programs to support specific types of businesses. The catch? They're highly competitive, and you'll need a strong project proposal that aligns with government priorities. But if you qualify, you get free capital for research, development, and innovation. This is best for startups in specific industries that can meet the eligibility criteria. Business incubators and accelerators are another avenue. These programs offer mentorship, resources, and sometimes funding to help startups grow. They can be intense, with high expectations for growth and development, but they provide access to expert guidance and a network of potential investors. Just remember, being accepted can be highly competitive, and you may need to give up equity in exchange for support. Lastly, we have strategic partnerships. Collaborating with established businesses can open doors to resources, expertise, and customer bases that you might not have access to otherwise. But these relationships require alignment of goals and values to avoid conflicts. If you play your cards right, this can be a fantastic way to scale your business. Choosing the right funding option isn't just about grabbing the cash. It's about assessing your capital needs, considering your growth stage, and evaluating how much control you're willing to give up. Each of these options has its own set of benefits and considerations, and understanding them is crucial for your startup's success. So take your time, do your homework, and choose the path that aligns with your vision and long-term goals. After all, this is your dream, and you deserve to see it flourish.